This is something called the Research Center on renterswarehouse.com. Now what you're going to see now is some pretty cool stuff. Think of this as a real estate video game. All right. If you're a real estate enthusiast, you're going to find this stuff to be a lot of fun. And we, over the years, in working with all these large Wall Street firms and professional investors, we gained mastery over big data around housing. I'll give you an example of some of the things that we cut our teeth on that got us a reputation on Wall Street, and that was that when the housing crisis was underway, we started this company not to go and capitalize on the bones of all that misery. That wasn't, and I'm not casting dispersions on anybody who did, but that wasn't our instinct. Our instinct was not, let's go buy up a bunch of foreclosures. Our instinct was, there's a housing crisis, and by the way, you can see it right here on this chart. See this chart? This is the last 20 years, 1996, 2005, 2006. Here's the big boom, here's the big meltdown, and here's the recovery. All right, so this kind of gives you perspective. If you think about all the news stories you read over the years and heard about the housing crisis of 2008, that's it right here, okay? So yeah, it went down, but don't let anybody tell you that this happens all the time. This happened one time since the Great Depression, and it was because we went slap happy in the lending business, giving blank checks to people. They spent money they didn't have. They drove prices up. The market didn't have any of that. And the market corrected and went back to, if you look at this line, by the way, the reason why it's choppy is that it's monthly. But if you look at the smoothing out of the line, you can see that the market kind of got back to where it wanted to be, okay? That's the US. And right around here, we said, okay, we're gonna start this company we've been dreaming about, a real estate investment company, because right now it is clear that nobody understands the housing market. So the government doesn't understand it. They're the ones that push lending standards. The lenders didn't understand it because they're the ones that allowed themselves to get pushed. Realtors were passengers on that train. They were making money hand over fist, didn't have a care in the world. And the consumer lost their heads on this. You know, people that had a blank check in their pocket for 400 grand, they were planning to buy a house for 225, but then they got a blank check for 400, so they went out and spent 400. They couldn't afford it. Things went bad. So we started the company here, and we were right. Our thesis was there's going to be an investment boom on this other side of this, and there's no real estate company, no real estate portal that's going to enable that and thereby build a business, a big business around it. We were right. Okay, big investment boom ensued. And our original thesis was, let me find a school district. Because you think about the people, the key to picking winning markets in real estate is understanding people, where they're going, are they staying, and why. And if all the why is still intact, the common sense associated with picking winners is really uncanny, and then you back it up with data, and it informs your opinion. Our original thesis was, let's go to school districts. Because if I think about a family who's losing their home to foreclosure, they have a lot of stress on them, and there are two things they're stressed out about. One is this financial mistake they made they want to get out from under. So they're going to give the keys back to the bank or do a short sale, but they're going to get out. They're in distress. They can't keep the house. Right behind that is their second concern, which is, how do I shield my kids from the impact of this? And the answer to that is keep them in the same classroom. That's it. That's what they're concerned about. We can move neighborhoods. We can change houses. They can go back to sharing a room. No big deal. But they need to be able to go to the same classroom. Different bus stop, same classroom, right? That's what was on people's mind. I knew it. We confirmed it. So we started running data sets and analysis to try to figure out where were the school districts where there were way too many foreclosure filings and way too few rentals, right? We found routinely 5 to 1. So there were 5 families in some stage of facing foreclosure for every currently available rental on the market. That meant if you bought more rentals in that part of town, you'd have ready tenants and they probably bid up your rent. When you have 5 families that need a rental, you only have 3 rentals, you can get $40 a month more in rent. And when you get $40 a month more in rent, you're not gouging, it's supply and demand, but your yield goes up, everything works out well. That's what made us famous inside of the Wall Street world of investing in single family, because everybody else was chasing beat up junker properties wherever they happened to be. We were following the demand. That kicked off our careers of representing and advising Wall Street firms on where to buy, and then of course we helped them buy and we helped them accumulate these large national portfolios. So now, along the way, we realized that, hey, we've got mastery around this data, everybody should have this. And so we took all the data sets that we already owned, bought a whole bunch more, and built the research center and the Renters Warehouse Investor Marketplace. So what you're looking at right now is to me, the money chart. Okay, literally actually, but I mean figuratively, like this is where it all starts. This is the thing that's the most important. How did the market perform over the last 20 years in terms of price appreciation? This is not some Case-Shiller index algorithm nonsense. This is the average sale price in that county, that month in history. Unadjusted for seasonality, unadjusted for inflation, just unadjusted. Because I understand it better when I see it unadjusted. I want you to understand it better also. So we saw the country, real estate boom, real estate correction, real estate recovery. And I want to point out, you see the heartbeats? High and low, high and low, right? Who wants to guess what that is? Let's do a free ebook. My CEO, Kevin Ortner, wrote a book called Rent Estate Revolution. And I'm going to give a free ebook to A, anybody who asks a question, and B, anybody who can answer this question right. Why do you think this is, why do prices go up and down, up and down, up and down, what seems like constantly throughout the last 20 years? Seasonality, check it out. June or July, February. July, February. Let's go up here. June, January. It's called winter and summer. It's called the spring market, right? Everybody knows the spring market exists, but there's like nobody in the industry that has ever run this chart until we did. And so nobody saw that. See, the reason why the market is busiest in this spring is that it's instinctual or instinctive. So this is an interesting observation, right? Just by virtue of visualizing data, you learn something, and that is that the prices are lower in the winter. Why are the prices lower? Because the demand is softer. Why is demand softer? Because everybody's trying to get their house hunting done in the spring when it's nice out. They want to get in the house in the summer, and they want to be ready to go to school in August or September. Simple. Everyone knows it, but did you know the impact on median price? So for example, nationwide, the average price was $224 in June, but the prior February was $197. The following February was $211 or $206. Look at that. There is a $18,000, if I have my math right, swing from peak to trough just because of seasonality. So what does that mean? That means that right now, I've got cash set aside. I've got an investment thesis that I'm about to execute on, but I'm waiting until November to do it. I'm going to load up in November because I can get a better price. Not because cheaper houses sell, but just fewer houses sell. So the sellers that accept offers in November or December, they really want to get the deal done, so they accept a lower offer. The ones that really are willing to wait will hang on till the next spring and get a higher price. So you wind up, because there's supply and less demand, you wind up being able to find sellers that are willing to acquiesce in the negotiation, give you a better price.